Hello everyone, today's video is all about EIS Tax Relief, Enterprise Investment Scheme. Now I've done a full separate video on this and all the tax breaks, but basically this particular video is all about how you can get it wrong. So EIS, just an overview, is a government-backed form of tax planning to encourage taxpayers to invest in smaller companies, not FTSE 100 companies. And if you invest in certain types of smaller businesses, you get tax breaks for doing so. Typically a 30% credit against your income tax bill. So let's say you put in 10 grand into an EIS qualifying company. It's only really going to cost you 7 grand because you knock 3 grand off your income tax bill on your tax return. Doesn't matter if you're an employee or self-employed, doesn't matter what kind of source your income is, even if everything's through pay as you earn, you'll still do a tax return and get your 3 grand back in this example, which would be a refund. So EIS Relief, been around for about 25 years. Really good incentives for people who are thinking about investing in certain types of companies, that you have this favorable tax break, in addition to other things like no capital gains tax at the back end when you sell the investment as well. But a lot of people will go into it for predominantly the income tax relief, because a 30% chunk off the investment in the form of tax relief is a big incentive. So in this particular case, it was a court case, and a company had written to HMRC to get advance assurance, because that's what you typically do. You write a letter to HMRC, you say, this is the business plan, this is what we are doing to attract investors. Can you please give us EIS status so that we can wave a flag in front of the investors to say that this will qualify for tax relief? Because there's nothing worse than if you are marketing this to try and get a few quid into your business as the company from the investors, saying HMRC will give us this relief when you haven't got that guarantee. So the advance assurance isn't necessarily a guarantee, but it's the next best thing, that if you stick to all the things that you've told them in the advance assurance, then the investors will get the relief. Now, what happened in this particular case, which has just gone to court, is that even though the assurance, the advanced assurance, was granted by HMRC, the company then changed their Articles of Association. Why did they change them? Well, what they wanted to do was give the investors a little bit more comfort, because these tend to be riskier investments anyway, because of the fact they are small companies, hence the reason the government give you such good tax breaks on them. But the actual company said, look, we're going to make a bit of a sweetener for these investors insofar as we'll give them preferential dividends on the shares that they subscribe for. So they basically split the company shares, A and B shares to these new EIS investors. And as the process goes for EIS, once you've got the money in from the investors, so you then go back and there's some more paperwork for HMRC, and you say, right, can you please issue certificates so that the investors can claim the tax relief on their tax returns? And at that point, HMRC processed it and said, no, we will not be issuing the certificates, because even though we gave you advanced assurance, you've changed the rules of the game, as it were, and you've altered the articles, the constitution of your company, so that the new investors wanting the EIS have got preferential rights on these shares, which goes against the whole rules of the EIS, which is all about giving everyone equal treatment, basically. So you cannot do that for EIS. You cannot give preferential rights for the new subscribers of these EIS shares. And the company argued in the courts and said, look, it's not, we rewrote the articles so that the articles are kind of fixed and dictate things. Going forward, there's nothing we can do to pay out on the company's discretion for these new investors. And the tribunal just said, look, that's a load of nonsense. You've you've legally changed the Articles of Association. It's fine. The companies are within their rights to do so, but that act itself did preclude the treatment for the EIS, because it gave the favourable preferential treatment on the dividends for the certain shares for the new investors hoping to qualify for EIS. So basically, the thing to look out for here is that if you are a company and you are wanting this type of investment from investors, make sure you get all the small print right, all the little details, because yes, the headline tax breaks are great, and it will attract a lot of investors. 30% relief, no income tax at the back end, superb. But it's all the little things that you need to get right, like not having these different types of shares that give preferential treatment for the new subscribers as a sweetener. You can't do that. So even if you try and be cute about it by changing the constitution and the articles rather than having separate board minutes every year to do so. So EIS, devil's in the detail, as with a lot of these tax rules, particularly these tax breaks that sound fabulous. You've got to get it right, because if you don't, then it can be a nightmare. So in this particular case, they would have applied for this clearance, and these investors did not get it. So it cost them the full 100% rather than the 70% they were thinking of. Many of them might want to pull their money back out. So you do have to get things right. So tip for the day, compliance again. Yes, it's great to have tax breaks, but make sure you get the paperwork right in the first place, or it can all go horribly wrong. So that's just an overview on the EIS scheme and specifically getting the detail right. If you like this video, do subscribe there, and I will see you soon.